I think we've satisfied the basic amount of waiting time. Again, welcome to this Placer AI webinar. We're going to be focusing on our retail real estate kickoff. I am thrilled to be joined today by two of my favorite guests, Megan Martindale, Principal Director of Market Intelligence for Retail at Avison Young. Thank you so much for being here. I
Thank
also
you,
feel like you were like
Ethan.
one of the first ones last year. I feel like this has become like a January tradition, and I love
This
it.
is a January tradition. Yeah, and I'm honored you had me back. So that's great. Thank
I
you.
mean, it's so much fun. How do you avoid doing it again? And the greatest, Ben Witten, our head of real estate here at Placer. Ben, thanks so much for starting off the year with me.
Ethan, you're the greatest, especially how you function on limited sleep, as we were just chatting. It's incredible. You're an
Uh,
inspiration. Glad to
if
be
anyone
back and
wants,
good to be with you again, Megan.
Yeah,
if
likewise,
anyone
Happy New
wants to
Ethan.
Year.
join, we're gonna at some point do a webinar about the things that really matter, like ways to fend off jet lag and the challenges of international travel for work. But that webinar, that'll come one day. As always, we're gonna start with a very, very quick introduction. We're gonna focus the entire block on what we think is coming in retail real estate. And then, as always, we are going to take your questions. If you have a question at any point throughout the conversation, please hit that Q&A button situated at the top or bottom of your screen, depending on how you have Zoom configured. And send those questions at any point. We'll try to get with them either within the flow of the conversation or save time at the end to answer whatever questions you may have. So quick introduction, again, for those of you who are unfamiliar with Placer, what do? We bring location analytics. What does that mean in the simplest version? People vote with their feet. We show you how they vote across the United States every single day. We do that by observing a panel of tens of millions of mobile devices. Very critically, this is all de-identified aggregate data. So we are GDPR and CCPA compliant. We then analyze that data with machine learning and AI algorithms and make estimations about visits to retail locations across the country. And we then present those estimations in a wealth of different reports within our platform on everything from the customer journey, true trade areas, visits, visit trends, and a whole lot more. If anyone is interested, we do have a free version of our premium product available at placer.ai. We also have free tools available on our website in a section called The Square. Please check it out. It's some really interesting things. But now it's time to get to the reason we're all here, the content itself. And what better way to start off 2024 than by asking the big question about the end of 2023? And Megan, I will start with you. What did we learn, or what do you think the biggest lesson was from the holiday season?
I think there's a couple things to point out. Look, people spent, whether you take a positive view that it's consumption surge or you take a negative view that it was like doom spending, right? People spent money and, obviously there was a lot more deliberate shopping, promotions. We had the extra weekend leading up to Christmas for Super Saturday, Rise and Buy Now, Pay Later, all of that was a big influence on the holiday season. But the two things I'm really taking away from a sales standpoint, and so far, we really only have the MasterCard data out. We'll get the census data next Wednesday. But, retail sales only include restaurants for services and guests for travel, and they are not adjusted for inflation. So when we think, that AAA and, other organizations put out, we had record travel, even though, according to the MasterCard sales, there was only a 3.1% increase in retail sales, you have to take into consideration all of the money that people spent through this holiday season that we're not going to get that same, metric for. So I actually think, overall it was a really positive holiday season. I know there can be some negative, media because some of the forecasts didn't meet expectations. I was in that 3 to 4% camp, so we'll see what census comes out with next year. But the other thing with MasterCard is they really only look at November 1 through December 31st. And so we know that, obviously everything's being pulled forward into October. So we really have to pull in the October sales as well. And I think the biggest thing for me that I think is actually gonna be a really positive takeaway is, last year in 23, we did a really in-depth sales analysis every month on a multi-year comparison. And we really saw retail sales growth normalize back to pre-pandemic after we had these huge surge, through the pandemic, post-pandemic revenge spending, then inflation. So I'm actually, you can't compare and keep comparing comp growth back to 2021 and 22. And I think the positive this year is going to be that 23 is kind of going to be 24, excuse me, is going to be kind of our first normalized year over year sales comparison through this year in, you know, kind of our post-pandemic world, as we are today.
That's a great point. That like it is the first time when you. I wonder what context we'll be talking about at the end of
Yeah.
this year. But it's a great point. We really shouldn't need. I mean, who the hell knows what's going to be coming soon? But like, we shouldn't need. If we know anything, we know we don't know what's coming next.
Right.
But we shouldn't necessarily need to do that same pre-pandemic disclaimer that we've been doing for the past few years. Ben, from your perspective, what was the biggest lesson we learned from the holiday season?
Yeah, I mean, it's looking at this slide right here, I think it's pretty amazing that a number of the names you see here, and even like the number two, Macy's, there's a number of department stores still showing up. And I think there's kind of this preconceived notion that the department store's dead, and everyone's shopping online and they're shopping on Amazon and elsewhere, and they're not going to traditional department stores. And I think the data clearly tells a very different story, that those department stores have continued to maintain relevancy and are still, whether it's peak holiday or it's throughout the year, continuing to stay relevant in a meaningful way. I think also just the flight to value and seek out, a good deal, right? So the outlet malls as compared to the indoor malls, that's a surge. I don't know that we've seen, in recent years in the same way, kind of that, 400% versus 300% increase is pretty interesting. And just a personal anecdote, we now have an outlet mall here, a Tanger outlet mall that has, a restoration hardware outlet and really some of the, better end, top end, home good merchandising and what have you. And so I think that's an interesting sector that just continues to evolve. And, today's outlet mall is definitely not what it was, 20 years ago or even, 5 or 10 years ago. So that's a asset type, I think, that continues to evolve, especially just as you see more integration of food and beverage and even some entertainment, what have you, that continues to bring the consumer out in a new way. So really exciting. On the MasterCard data you were talking about, Megan, it's interesting, like retail sales online were up a little over 6%, brick and mortar was like 2, give or take. And so still seeing about 3x growth in the online channel, but still seeing, solid growth brick and mortar as well. I think when you look at inflation adjusted, it was kind of on par with 22. So there's, maybe there's some reticence from the consumer to go out and spend like crazy, and some of that revenge spending, if you will, has been, tapped out. But it'll be interesting to see kind of go forward. I do think the value segment and outlets will continue to really see kind of some of that positive outperformance.
Yeah, I mean, it's a great point. I think the other thing that bears noting is Black Friday, which I think kind of always gets this. I mean, look how much worse it is than it was in the past, as opposed to, hey, it's still a pretty big deal. And for a lot of retailers, it's a huge deal. And every time we kind of dive into the numbers, you try to, again, it's this comparison to like, is it the peak of its powers? No, but it's still a very, if not the most powerful day in kind of the world of retail. One thing that was really interesting to us was we think about, and you mentioned this a little bit, Megan, we talked about kind of we need to consider October now, is the phases of the holiday season, the stages that take place. And, like Ben, I'll start with you here. We talk a lot about how this holiday season has been kind of lengthened. Other retail holidays, things like Cyber Monday, Super Saturday. How does retail strategy need to change to maximize these shifts? Like this extension has a huge impact.
It really does. And we talked briefly about department stores, a moment ago. I think, one of the things department stores have going for them, is they're connected to malls generally, right? Either lifestyle or an indoor mall most often. And so when you look at kind of the fourth quarter and the holiday season and thinking about my mall days, what does that mean, right? Well, generally the indoor mall is in a lot of towns, especially smaller towns, it's kind of the town square for Santa and Christmas and activation and the family experience and all of that, right? And the box office, there's often a theater associated. And so you kind of bring all that together. And I think it certainly can be a recipe for success when you bring it together in a, impactful way. Just thinking of, like when I was at Trademark, we had, Galleria Dallas and a snow day Instagram museum that did a pop-up basically for 90 days and was a massive traffic driver and drove a lot of visits also to the stores and the anchors and everybody in the ice rink. And so I think really relying on that kind of interwovenness of activation, pop-ups, leveraging influencers and marketing and all of that. Really, the as you can see, like the department stores are really a kind of a unique animal, and I think when those work in concert with, the mall operators and all of that, there really is an opportunity for outsized performance.
Megan, from your perspective, kind of the same question, but from the retail real estate perspective. What are the
Okay.
things, what are the ways the strategy needs to change to account for this kind of more diverse, longer, different holiday season?
Yeah, and Ben touched on it. I mean, you have to match the consumer buying cycle and what retailers are doing to meet that at the shopping center level. So, when we think, it used to kind of be, okay, you had tree lighting kickoff, after Thanksgiving, and then you were really gearing up for Black Friday. And, at the shopping center level, you have to take into consideration operations, parking circulation. What are you doing to keep things clean and safe? How are you dealing with the media, the events, the activations, holiday markets, all of the things that, you do to kind of create that Christmas holiday shopping energy. But now because that season is elongated, right, you're having to start that process earlier, right? We're actually looking at the shopping centers in October. Now we generally still follow a traditional cadence in terms of the big signature events like tree lighting, when Santa starts, Black Friday, things like that. But you really have to pull it, the operation side at the shopping center level forward into those October, that October month, to match kind of when a lot of those early promotions and, the competing Prime Day sales and things are happening. But you also have to keep in mind the consumer and still create that draw and how you're going to get them back to the property that whole quarter, right? If people have done a lot of their shopping in October, you don't want them not to come back to your shopping center. You want to create the activations, you want to create the events, you want to create a reason to still come back, even if they're done early shopping or you're capturing the procrastinators that we always see with that kind of little late December surge. You really have to be, I think, a lot more strategic on the property level to know that you're meeting that early expectation, but then, and our teams work so hard October through December to execute on that whole holiday strategy to make sure that you're bringing people back in and, point back to the MasterCard data again, restaurants were up like, I think it was 7.6%. So, there was a ton more gathering at the properties this year, restaurant reservations packed, events, the entertainment, operations that we have. So even if people were done sort of early shopping, they were still coming, for those holiday events and activations. And that's a really key strategy now that, we've had to deploy on several different levels to make sure that our operations side is matching what that new, consumer cycle looks like.
I mean, I love that example so much because I think one of the things we've spoken about a bunch is the fact that different people are going to be motivated by different polls
Yes.
throughout the holiday season. So I'm an early shopper. I like to get stuff done in October because it makes me feel less panicked as we get closer to the holiday season. So the thing that's going to get me to go to the shopping center could be a dinner out, it could be an event, but it's not going to be the shopping.
Right.
And there are other people who are going to go later, so they have to figure out what's the draw in October. And I think that understanding that consumers are driven by these different pulls is and motivations, I think is so critical to driving it throughout the season. Let's kind of shift focus now heavier into 2024, but let's kick off positive. And I'm going to start with you, Megan. Give me a retail segment, and you can go crazy and give me a retailer instead if you'd like, if we want to go absolutely wild, that you're particularly excited about in 2024, and tell us why.
Well, I'm going to go a little different than traditional, but I have a renewed interest in this slow fashion versus fast fashion because I think we're seeing just this dichotomy of how it's playing out where, in some respects there's been a backlash against fast fashion, right? H&M's closing stores, there's, all of the issues surrounding sustainability and labor and, all of this. But then at the same time, you have Shein, who just partnered with Forever 21 in third quarter. You have Temu on the rise. So we're seeing huge growth in that. Now, the anecdote to that has been, slow fashion and circular fashion and, all of that capturing consumers' desires to be more sustainable and, think about labor laws and all of that. But what I find so fascinating right now, and I'm looking forward to doing a tour of stores this year, is that I think we're seeing that slow fashion movement come up to a whole new level. Like I think of the original players as like Eileen Fisher and Patagonia and Reformation the last decade, but now all of a sudden, there's so many new brands that have merged, and some of these are really high fashion. I mean, we're talking luxury brands. There's the new self-portrait store that opened in London. We're seeing Cotopaxi. There's and I don't play in this space as much as I used to in my development days, but I love the design element of retail, and I just don't get to do that as much, in sort of my new role. But there's if you look at what is it? Oh, EcoAlf in Spain. It's the first store worldwide that's been made 100% from recycled plastics. A lot of it was marine debris and recyclables from hospitals. This store is absolutely stunning. It's just outside of Madrid. So I think it's having a moment again, and I don't think, we're going to see the sales catch up to fast fashion anytime soon. I mean, it's still fast fashion's in this explosive growth phase again. But what I'm appreciating about it is that it's almost like the slow fashion movement's becoming a little bit more mainstream, and we're seeing it materialize in tangible stores and things that, people can touch and feel versus this kind of esoteric philosophical, yes, we want to do better for the earth. Yes, we want to be better citizens, but how do we execute that when you boil it down to how people are spending money? And so I think we'll see just so many new brands exploding, and a lot of them, to Ben's point, started with pop-ups in department stores, and now we're seeing the first retail stores open around the country. So I'm pretty excited to see kind of what unfolds, and it's not true transparency, like it's not a category I've super paid attention to the last couple of years, just because we've been in like these huge swings of pandemic and post-pandemic and how the categories are affected. But it's kind of nice to see something sort of new emerging, and it's almost like putting your money where your mouth is a little bit, that we can actually see some of this coming onto the retail landscape and to some of the high streets and shopping centers.
It's amazing. It also taught me that I've been saying Cotopaxi wrong.
Well, I don't know. I think it's
I mean,
Cotopaxi, but
I don't think it is, if you knew what I used to call Shein, that you would know how terrible I am at this. But Ben, same question for you. Give me a retail segment that you're really excited about in 2024 and tell me why.
Yeah, I'd say there's a couple that I'm excited about. Probably first and foremost, I think, brands that are in the ethos of, fewer but better products and really focused on quality and specialization. And so whether that's, a Viore or, Alo on the athleisure side, where we're seeing, in the kind of the early innings of store expansion and going some of the best lifestyle and mall centers in the country. And Viore, by the, beautiful stores, right? So they're heavily invested in the experience and the aesthetic and all of that. And so I think, when you have a great product, which I got my first pair of Viore pants last year, and when I got them, I think I wore them probably more days than not for about a month, just because they're so amazing and comfortable. But it goes to the concept of just an incredible product, at a attractive price point. There's the whole kind of ethos of the brand, the story of the brand, the store experience kind of, embodies what they're trying to do. So I think those types of brands that are in a segment, like athleisure are set up to see, quite a bit of success. On the flip side, I do think the fast fashion or the, value, mass merchant, I don't even know what you call it, the Sheins and the Temus. Like the other day I was researching new drill bits for my drills, and later that day in my like weather app, I got a Temu ad for like a DeWalt special shelf just to hold your drills and drill bits. And I was like, what? I've never even seen that before. But it'll be interesting to see for those types of brands that they seem to like sell and have everything, whether it's like a Stanley mug or whatever it is that you're looking for. It'll be interesting to see how those types of tenants get treated in a, mall environment where there's so many restrictions and exclusives and what have you, and if, there will be barriers that are either in place or will be put in place to preclude those kinds of tenants from selling like literally everything or anything that they want to sell that they could compete with incumbent tenants. So that'd be an interesting one to watch.
That's super interesting. One of the things that I think we've talked about a lot, our own head of analytical research was hammering this point home towards the end of last year of value continues to be unbelievably important in the year to come, and value is not a simple concept. I think there's two elements to that. One, the idea of, value is not just the cheapest. It's a perception of how much it should cost versus how much I'm willing to pay for it, and that obviously has dramatic changes. But also this idea that economic uncertainty is a complicated concept. Like it means different things to different people, and it's not the same thing as, all right, it's a challenging period, but I know it's going to end. It's a challenging period, and I don't know what's going to be 3 months from now, and that comes with its own kind of challenges. And Ben, starting with you here, we know that value is a big thing in 2023, and it had a huge impact on consumers. How big of an impact do you think it's going to have this coming year?
Yeah, it has had a massive impact with the hyperinflation we saw, the last couple of years, the supply chain issues, right? All of that has definitely driven, I think, a good portion of the consumer to value and discount and dollar and et cetera. And I think kind of twofold, one aspect of it is this concept of affordable everyday luxury. The consumer still is looking for ways to treat themselves, right? Like, I deserve this, or, I need my Dutch Brothers coffee or my Starbucks or whatever. I need my latte, right? Like, no matter what happens, I'm not going to give that up. That's something I deserve or need in my daily life, right? So I think there is kind of this mindset, and we see that with a lot of these brands, and maybe, looking at non-family data, right? Obviously, without kids, especially dual income, no kids, there's obviously more disposable income to go around, absolutely, right? So kind of putting that in context is kind of an interesting idea. But also, I think just value at large, and even whether that's fast fashion or it's discount and dollar, I think that category continues to see tailwinds in 24. Just if you look at some of the recent Fitch reporting around, some of the rising headwinds for consumers, whether that's, higher credit card debt, reduced savings, coming out of the, stimulus that we saw years ago, and even the reinstatement of, college loan repayments. There's some challenges, I think, that could put some strain on disposable and discretionary income for the consumer. And so it would be interesting to see what that does. It's hard to think that it doesn't influence and drive more consumers to that value category.
Megan, from your perspective, how do shopping centers, or how should they, or how can they deal with these periods where there is this extended cycle where value is of such primary importance?
Yeah, I'll answer it a couple different ways. So first off, it depends on what your merchandising mix is. I mean, if we're talking a grocery anchored, drug anchored neighborhood community center, they're pretty much recession proof. They're not going to have exposure to any kind of pullback in spending that you might see, at a higher end or luxury mall or a lifestyle center or something like that. So there's some bifurcation within even the shopping center segments. I will say, for the centers that are sort of non-daily weekly needs, right, where they're more fashion driven or entertainment, things like that, I think we're looking at it from a couple different angles. First, obviously the consumer, like Ben said. I do still think that shopping center environment, when it's executed right, can provide those little luxuries, not just from shopping, but from the experiences like we were talking about for holiday. If people are pulling back on travel spending, but they're going to go locally to more events, and, we're doing cool activations or artisan markets or, movie night for kids and things like that, we can fulfill that almost kind of third place. Like, okay, we're going to pull back in other big spending areas, but we can kind of stay more local and regional and still have family outings and still have date night and, kind of capture that from the consumer side. On the shopping center level, when I look at, retail compared to the other asset classes, we have more levers to pull to monetize the assets and preserve, NOI. And, you know, all of the things I'm about to say should be happening all of the time, but I think especially, you know, in times where we can see some economic contraction. I mean, we have, you know, pop-ups, we can generate alternative revenue through revenue sponsorships and, you know, brand sponsorships and digital media, events, activations, you know, but it's also at the shopping center level a time when you have to get a lot more hands-on with your tenants and supporting the retailers, because if you have really strong performing retailers, if they're value, you know, players, or if their sales are really strong, you know, you want to maintain that momentum, especially if they're either already in or on the threshold of any kind of percentage rent. You know, you want to nurture that. But this is also a time where we're going to start seeing some retailers struggle again. And it's being really hands-on, you know, kind of lifting them up and seeing, okay, you know, is there a strategy to help them kind of ride through this, especially on the local mom and pop level? Or do we need to start looking, you know, from the landlord side at not sure they're going to survive? We need to start looking at some replacement strategies. So, you know, there's a lot of nuances to it, but, you know, we're obviously tracking the consumer carefully, what impact that has on the retailers. And then we have to be really smart about how we know we're combating some of those issues at the shopping center level.
Yes, I mean, it's super important. I want to get to some of the questions. So, you know, someone specifically asked about, I'm here to receive the return to work analysis. Am I in the wrong session? We are actually going to talk about that topic very soon.
It's a good setup.
Yeah.
Which is great. And so you know what, we'll do one better. We'll go straight to that because you know, we're gonna have to skip something. Might as well skip this. I'll start with you, Megan. Is this the new, or what we're seeing essentially now is this recovery to about 30-35% down? And there's obviously differences in terms of cities, San Francisco more, New York better, you know, in a variety of issues that impacts every place. Is this the new or normal in office? And if so, what does it mean for retail?
I don't know what the final number is. I think return to office is definitely going to improve this year. I think we've been, you know, kind of in the big debate. We've been in the power struggle between employees and employers, but I do feel like we're going to normalize some this year. I don't personally think we're going to get back to full office occupancies in at least the urban cores, which ties into what we just skipped in mixed use and other topics.
Yeah.
But, you know, I think we've seen such a shift in the impact to retail from office, because as people started working home for more, you know, you can point to a ton of data sets of how the day part shifted. You know, they're buying lunch at home, they're buying more groceries to make lunch at home, or they're going out near their, you know, home office for lunch. And so you saw the impact, especially on a lot of the urban retailers. And it was everything from restaurants to shoe shine to dry cleaner to nail salons, really big impacts. So, you know, as more people get back into the office, and I think get especially back into commuting, the commuting factor is huge. It's one thing to say I'm working in the office, but if you moved during the pandemic and you are now in a job where you have to get back into the office, and you're either back to your old commute or you've added to your commute, which I know a lot of people have, you are going to do more of those daily, you know, weekly needs and services by your office again. So that's going to kind of shift that pendulum back. But I also think, and there was an article, I think last week, where they were talking about, it was actually a side hustle article, and they were talking about how more people are going back into the office. There's going to be a huge opportunity for side hustle gigs for, you know, house cleaning and laundry service and things, because people are going to be out of the home again after we've been home for, you know, 3 or 4 years, depending on where you live and work. And so the things that you're used to doing at home now, if you don't have that time there, you're going to have to find a resource to do it, you know? So it's just a matter of kind of, you know, it's like shifting marbles back and forth in jars, you know, the dollars are going to be spent. It's a matter of where and how. And then, you know, I just don't think we're going to get back to that full occupancy level in the urban core, but I think that rebound is going to be really healthy for the retailers that are there, whether they survived or they come back into the market.
I mean, it's a great point. I think the other piece is like, how do you incentivize those dollars to be spent
Right.
for you? So one of the things we've talked about a lot is there's certain retailers who are well positioned because of the lack of return to office.
Yeah.
Are they doubling down on what are the things that worked in their advantage too? A question came in, Ben, and I'm going to come to the same question with you. Do you think this is the new office normal? What does it mean for retail? But I'll add the caveat that a question came in. Most recent data stated 20% office vacancy. Do you think that will grow or improve in 2024? And very critically, what we're talking about here is not office vacancy, it's return to office. So it's visits we have in all those various cities, we have hundreds and hundreds of office buildings that we're looking at. They're usually better performing A-class buildings. So that's what we're looking at. But this is, I think the question is specifically referring to office vacancy from in terms of tenants.
Yeah, definitely. So the kind of the first part of the question, this definitely is the new normal in terms of, nationwide. If we're going to paint with a broad brush, we're generally seeing, that days in office are about 60 to 65% of what they were pre-COVID. And as we can see, that has somewhat flatlined for some time now. I do think as the momentum or the negotiating power maybe shifts back to the employer, as Megan was saying, that does shift. And as you see more return to office mandates, you do see more days in office. So that is a theme that probably does, continue to play out and take shape. But even still, if you look at, forecasts of, where is unemployment today, where are we likely headed next year, 4.5%, it's still very much a employee favored, environment as compared to other, downturns perhaps or other environments. So that I think that'll be interesting to play out to see what happens there, right? What we're generally hearing is that there's a flight to quality, and where companies are up for renewal, they may be taking anywhere from 70 to 85% of their previous footprint, and so they do have functions, whether it's back of office or certain accounting functions or support functions that don't need to be in the office, or it's a call center, right, or whatever it may be. Many of those functions they may be able to attain labor at a lower cost if they do offer remote work, or it may just not be necessary to be in the office every day, or only come in for an all hands, once a month, or at some other, irregular cadence. And so generally speaking, hearing would expect that to continue, that companies need less space. And when they're up for renewal or looking at options, they're looking for the best option in the market, where, if they're taking 80% of the space they had before, they could pay 20% more, right? So they're basically kind of on par, but they're getting better space that's better for recruiting and retention of talent and the labor that they're trying to bring in. So generally that's what we're seeing. Now, the winner on that deal, right, obviously is the trophy assets and the top end of the market that's walkable and well amenitized, et cetera. The losers in that are, the A minus or B and below, that are not as walkable, don't have the amenities, right? And so that's really where I think the need will come for coming up with, creative and adaptive reuses of those assets.
That's great points. We did get a message that came in that said, go back and do mixed use. So who am I to say, who am I to say no? We're going to go back to it. Ben, I'll start with you here. I think mixed use has been a topic, and we've been discussing this for a long time, and it's because I think it's a super important and influential trend. And we could discuss this for the next. We could do webinars just on this, and we wouldn't have enough time to cover everything. Why are the lines continuing to blur, and what does it mean for retail real estate professionals in terms of, like, I think the day-to-day work sometimes gets overlooked when we think about these trends of, like, oh yeah, it's more mixed use. Great. What does that mean for that day-to-day work?
Yeah, I think it means a few things. I mean, as a theme, right, employees want to work closer to home, and people want to live closer to work, right? And so mixed use is the ideal scenario where you can combine those two things. And really, it's become cliche at this point, but really where you have an integrated live, work, play environment where I can live most of my life without the need for a car, or a couple of days a week. I have the ability, maybe it's just on the weekends, where I can, live in my apartment or townhome and walk to my favorite restaurants, or walk to my gym, or walk to pick up my dry cleaning or groceries or whatever it is. And I think that concept really resonates for a lot of reasons. I mean, you look at ancient societies and the way cities used to be built, hundreds of years ago, right? And obviously pre-car, and the reason that those have continued to thrive and are so desirable, we all pay thousands of dollars to go visit them, right? It's because they're just so pleasant and enjoyable, and they're activated, and they're authentic and have, all of that going on, authenticity. And so, that's a theme I think that certainly also resonates here in the United States, right? So that's a big one. And we also see on the return to office topic, shorter commutes are correlated to higher return to office. And so the closer someone can live to work, the more likely they are to go into the office. And you look at JLL's data around, mixed use real estate, where you see office buildings that are in a mixed use environment command a rent premium. Apartments in a mixed use environment command a rent premium, 30% plus. And so in terms of, being accretive and attractive to investors and developers, if you can execute mixed use well, there's a financial benefit to doing so.
Yeah, that's a great point. Megan, when you think about the trend overall, why do you think it's a big deal? And how much do you think it's changing the way that we kind of approach retail real estate?
So I've been working on mixed use my whole career, which this year is 24 years. So I'm going to take a little bit more anecdotal approach. I haven't formally studied this, but actually I will this year. And I'm generalizing here. Of course, there's always, nuances. But when I think back to early in my career, the big push on mixed use, which was probably like 2002 to, sort of leading up to GFC, it was a lot of suburban mixed use because you had huge growth predicated on housing growth in these markets that didn't really have that there. So we were building town centers. I leased and developed several projects where you had, and for the most part, it was a mix of retail, office, multifamily and hotel. And it was creating that, it was new build, meant to feel like it was part of the community always, right? But you were kind of creating these artificial town centers, if you will. And I think if I fast forward to now and in what we're talking about with mixed use, there's really that shift of looking at mixed use back to the urban core, Midtown Manhattan. How do we bring in more residential? So it's really about revitalizing some of these local communities that, especially during the pandemic with other demand drivers being down, need that resi component. And then also, as Ben said, where can I sort of live, work, and play? I think the other couple of factors with mixed use is it was always live, work, play, and now it's learn, it's healthcare, it's educational, it's community, it's recreational, it's green space. I mean, the components that we're building into where you can't do it in an urban environment always, obviously, but it's really expanded how we define mixed use versus just kind of those 4 core product types. And now we're, having to account for things we were not accounting for, 20, 25 years ago, more smart buildings, electric vehicle parking. We hadn't had the shockwaves to the office yet. So now it's like, how does space become more flexible so that if we don't get people back to an office or if, some other sector starts thriving, how can we kind of morph and play with that space? So it's a lot more flexibility. It's obviously a lot more digitally connected, so those were the elements that 20 plus years ago, we weren't necessarily focused on just because the technology wasn't there. And we were building really kind of with the same purpose in mind, but it was different, right? It was building new in suburbia to kind of create this. And now it's coming back in and revitalizing and looking at some of these communities that'll really benefit from having that ability to be people there, to have people there more on that 24/7 cycle.
I'm fascinated by this topic. In your opinion, when you think about that need to be more agile in terms of what a space could be filled with and what you might need to fill it with 3 years from now.
Right.
What does that do to the way you develop centers, to the way you build out I mean, are you trying to be more constrained, a little bit less kind of, I don't know, like how do you kind of find that balance? Because there could be a fundamental shift a few years from now and you want to do different things with the space.
It's a multi-trillion-dollar question everyone's trying to figure out now because, And look, I get it. The easy fix is, just convert office to resi. Well, it's not that easy. A, it's expensive. B, you've got zoning issues, regulatory issues. The older buildings with kind of more open floor plates and column spacing tend to lend themselves better to conversion than newer, Class A office buildings. So, it's really complex. And I think the way we built for 50, 60 years was very singular use in mind. We weren't building for flexibility. And now, and this is part of what I find fascinating as we're trying to solve it as an industry is how do we build for flexibility now? I mean, when you really get down to MEPs and building plans and architectural drawings and design and still thinking about placemaking and all of the things that go into making a property successful. You can't underestimate how complex it is. This is really what we're trying to solve for. And, the way we build, there's not an easy fix. So now it's really going, okay, how do we do that? If I'm going to, there's not as much new build obviously going on, but as that starts to heat up again and we start to find ways to reuse older buildings, what is this going to shape from, just a design and a use and, functional obsolescence standpoint, going forward. Because I think we're going to look back in 10 or 20 years and we're going to see this as a real defining moment in terms of how we define and use space for that flexible nature.
That's
I would
such a-
totally echo what you
Yeah,
said, Megan.
please.
I think an interesting example of that is if you look at, some of the newer like lifestyle centers that have been developed in the last 10 years or so, and everyone has been talking about autonomous cars for some time, but like
Yeah.
what it's been interesting to see a few developers that have taken the approach of, hey, today to meet parking code, we got to build a parking structure, but we're going to make sure to, make as many of the floors as possible flat. And we're going to
Right.
make sure that, the footprint would be accommodating to, or future conversion to residential or to office. And so, and the ceiling heights, right? All of that and windows and everything. And so I think just to your point, right? It's like you see developers being more proactive about it. I think there's this, 50 years ago, it was not the case. It was kind of like we're building a mall in the 80s and it's going to be a mall forever, right? Today, it's like we have the hindsight or we can look back on history and be like, okay, this is probably not going to be this forever. So let's build it in a way that it can be something else in the future, whether that garage needs to be converted to residential or an office because Elon Musk delivers autonomous cars and we're all going to be arriving from an autonomous vehicle, right? So
Yeah.
it's super interesting.
Well, and I think just one more thought on that. Now we're in this phase, and a lot of this came out of the migration patterns of there's so many microeconomies now. What works in Los Angeles does not work in New York. What works in parts of Florida doesn't work in parts of Texas. Like, our industry has been so segmented and fragmented, obviously. All of the real estate sectors have. We're seeing more of this hybridization of it, but there's not a one size fits all to any of this. I mean, you can come up with, great case studies and, how we're seeing kind of this future be sort of redesigned and the path forward. But then you also really have to take into consideration the local market conditions, what the microeconomies are. The trade areas have shifted drastically in the last, 5 years. So it's also being thoughtful to, okay, it's not just the functionality of the space, but we've also seen the landscape and the trade areas change so much that you have to build in some flexibility, even anticipating some of those, demographic shifts.
Great point. There's also the element that you see here, that pendulum shift swing phenomenon, where we're going from too single focus. It'll probably go too focused on having flexibility, and
Yeah.
then 20 years from now, someone's going to be like, well, for so long they were just building it for everything, and now if we build it specifically for retail, it makes it better. You watch how these things happen, and it's not. Sometimes we look back and we're like, oh, what a stupid choice. It's not. It makes a lot of sense within the context, and you see how these things happen.
Exactly.
We are running really short on time, but I want to get to one question. We're going to do this as quickly as we can, so you get sharp answers, guys. What asset class does everyone see prospering going into the new year? Megan, you get to start.
Well, I'm biased, but I'm bullish on retail. So as long as capital markets start to shake out, we start to see some rate drops, second quarter, I think, or second half of the year, we've been really resilient. And we had already started to see some of the institutional money come back into retail, where they got priced out of industrial and multifamily. Office is still somewhat debatable. Industrial showing some signs of slowing down, except for probably cold storage. So I'm very bullish on retail. We just need the markets to start cooperating so we can free up some capital and see some things trade.
Ben, your turn.
I would agree on retail 100%, just in the sense of if you look at, Odyssey Fund capital allocations, 10 years ago, 20% of, institutional capital was going to retail. So it was 20%. Today it's closer to 10%. And with, dollars coming out of office and there's so much competition for dollars in industrial multifamily, that capital has to get reallocated. I think simultaneously, like COVID proved that strong retail performed incredibly well. It's been stress tested in a way that it never has before. And so I think where retail used to be perceived as pretty risky, I think good retail is now perceived as a much more of a core asset class. And so it's hard to imagine that, allocation to retail doesn't continue to or start to trend back up with more dollars flowing into retail. I'd say on the kind of non-traditional asset classes, I'd say data centers, given all the hype and hysteria around like AI and chat GPT and everything else, and all the supercomputing that's going to need to happen, that's going to provide, some major tailwinds for data centers.
One. We had other great questions. Thank you so much for asking them. I apologize we weren't able to get to everything. Megan, Ben, thank you both so much for being here and joining us, kicking off 2024 with a really enjoyable conversation as always. Thank you both so much. And thank you all for joining us. We're going to be doing our next webinar is in 2 weeks. I think 2 weeks from today, if I'm not mistaken. It is going to be our retail kickoff. We have our good friends Simeon Siegel from BMO and Jason Goldberg from Publicis. We're going to be joining us. We're very, very excited. Megan, Ben, thank you both so much for being here.